Hey folks, so it looks like the debt ceiling might actually get worked out. Well, the Dow Jones hasn't done anything yet. Actually, it's down because there's still some likelihood that we have people on the far right and the far left to kind of really monkey this thing up. But it will be resolved. It will be resolved soon because we've seen this 76 times before. Do you realize the debt ceiling has raised 76 times in the past? So relax. Everything's going to work out. Let's get over to the economic news just to see what's there that might be affecting the markets today. So the only thing we really have on the agenda today is the JOLT index. What the JOLT index is how many job openings there are. There's 10.1 million job openings. Well, there's 3.5 million people looking for jobs. So there's a little over 2 job openings for every person out there. So there are still jobs there and there's still employers employing. This number was expected to plummet because they're saying, well, employers are going to stop hiring because a recession's coming. So this is a concerning number and we're going to pay attention to this. Tomorrow we have more jobs numbers. We have the ADP number coming out. I hate it. It's never right. Initial jobless claims and so forth. So let's worry about that tomorrow. Right now we're focused on the debt ceiling and the Federal Reserve. So right now I found a new website for you guys to go to. It's called Kalshi.com. Check it out. It gives you all kind of expectations of what the Fed's going to do in regards to rates and so forth. It says federal rate projection is 5.5 in June, up from 5.25. These guys have been nailing it for the last year and a half. So I'm going to go on their side. I'm going to say now, I guess the Federal Reserve is going to raise one more time, but we're going to check out the Chicago Mercantile Exchange to see what in fact is actually going to happen. So to do that, we go over to this. This is the Chicago Mercantile Exchange. All right, let me get my head out of the way. And as you scroll down through this, you're going to see what in fact is this. Well, this is what is the likelihood that the Fed will change the federal target rate at the upcoming FOMC meeting. So they're going to meet in June. What are they going to do? Well, if you go down through here, this is going to give us some predetermined futures. So this is the futures market. These are people betting on Wall Street what's going to happen. So the Federal Reserve recently raised rates to 5.25. So it's between 5 and 5.25 right through here. These two lines over here weren't even here 30 days ago. Well, then they popped up and they were basically zero. Now look at them. So what does this mean? Well, basically it says in June, the expectations now are 54.9% chance that they're going to raise rates 0.25%. If they don't, they're most likely going to do it in July. Here's the scary thing too. If you go over here, this column just came in today, and now there's maybe almost a 20% chance in July they raise again. So I'm not on that bandwagon. I actually wasn't expecting this one to change, so we'll find out on June 14th when they actually come out and do things. So what I want to talk about today briefly is reverse FOMO. So what in the world is reverse FOMO, you might be asking? Well, think about it this way. Back in 2020, people were flushed with money, and a lot of you guys disagree with me. I had one comment say, well, Dan, the government sent out one stimulus check for $1,200. How did that cause so much havoc in the market? Well, there's a lot more to the story, and that's why I try to do these videos to teach you guys all the essence behind everything. So think of it this way. Back in 2019 and 2020, I was a proponent when the government came out and said these two things. If you own a house, you don't have to make a mortgage payment up until at least a year, and then they made it a year and a half. That was number one, and it was called forbearance, and I'll talk briefly about that here in a minute. The other thing is when they said you don't have to make your student loan payments either. So think about it. There was a lot of families out there, and there were studies done, and I proved this on my channel, that 70% of the last stimulus check that went out went in people's savings accounts because most people didn't need it. There are many, many people out there that did, so no disrespect to you guys out there. But you might not have needed it. So let's say you didn't need it, but you got the check. Then the next thing people did is when the forbearance thing came up, where you didn't have to make your mortgage payment, there was really no qualifications for it other than you had to have a Fannie Mae and Freddie Mac loan, which that's probably 85% of all the loans out there. All you had to do is call your servicer or your mortgage company and say, I'm affected by COVID, I can't make my mortgage payment. Okay, so think about it. Average mortgage payment, let's say, is $2,200. So now you have your job, you have the stimulus money, now you don't have to make a mortgage payment. Well, it gets even better. If you have student loan payments, well, you didn't have to make those either. If you were renting, a lot of people didn't have to make rent payments. So think about that. If I didn't have a mortgage payment and I didn't have my kids' student loan payments, I'd have no bills. I don't have a car payment. And I very rarely try not to use credit cards. So that's all my bills. So I'm getting my job income, my stimulus checks. I got no bills. What in the world am I going to do with it? So that's why I showed you consumer discretionary income in 2021 was the highest level ever in history. Okay. So you had all that in the backdrop. That is what basically is causing the inflation that you're seeing today. So today's video, though, I wanted to talk a little bit about reverse FOMO. And what in the world do I mean by that? Well, what I mean by reverse FOMO is this. Remember back in 2020, when we were just discussing all those perks to people had a lot of money. They were buying houses hand over fist because they didn't, if you were renting, you didn't have to pay rent. You didn't have to pay your student loan debt. You didn't have to pay a lot of things. And most likely you were still working. So now you have this excess money. So people were going in saying, I'm buying real estate because basically mortgage rates were the lowest ever in history. In history, folks. Okay. So people were buying houses. They were able to afford a ton more than they otherwise would be. Okay. The average rate in the whole country pre this last decade was say 7%. Okay, so that would be the norm. Could you afford, if you owned a house, could you afford that $500,000, $600,000 house that you just bought, that you were able to afford at 2.5%? Well, now the rates go to 7%. Can you afford it? No, a lot of people cannot. Well, that's how it used to be. So now what you're seeing is people sitting on the sidelines watching media and watching everything else saying, because all you hear is the market's going to crash, the housing market's going to crash. I keep asking people why, but you just hear, well, it's going to crash. So we have a ton of people sitting on the sidelines waiting for that housing crash, okay? Then you have a lot of people sitting on the sidelines, which I get it as well, saying mortgage rates are they're decade highs, and everybody keeps telling us they should be back in maybe the 6s or 5s, so I'm going to wait for that. Okay, so now you have those two camps sitting there waiting for house prices to crash and mortgage rates to come down. What if they don't? What if the new norm is 7% and house values basically flatten from here and just start escalating at a natural progression of 4.5% a year nationally? Okay, that could happen. It very likely could happen. But what you're probably going to see is people sitting on the sidelines waiting for that magic button to hit or magic numbers to hit saying, okay, the housing market's going to crash. Well, by how much? Because if I'm an investor on the sidelines, if I'm looking to buy stocks, I know my entry point. So let's say, for example, your entry point is in my area, I want prices to drop 15%. So you wait for 15%. Well, me, as the savvy investor I am, and I want to beat you to the punch, what am I going to do? Well, I'm going to wait. Well, when the market hits maybe down 10%, I'm going to jump in the market. Because I have millions of people behind me waiting for that 15%. Because when prices drop 15%, if they ever do, you're going to have this whole horde of people coming into the market. What happens? Now you have way too much demand, still not enough supply. What's going to happen? Prices are going to go up again. So there's a reverse FOMO going on right now. What I'm saying is people are waiting on the sidelines, waiting. One of two things is going to happen, or three things. The market's just going to stagnate and stay here. So you can then pick an entry point there. Or the market might go crash. And then what is your entry point? That's where you got to talk to your family and your realtor and your financial planner and your mortgage person to figure out what the numbers need to look like for you. Or home prices go up and mortgage rates stay steady. What are you going to do? Okay, so that's what you have to decide and educate yourself on. What do you think is going to happen and the probabilities of that? So that's today's video. So without further ado, let's get over and see where mortgage rates are headed today. So today we have the MBS market up 28. That is fantastic news. So this is what I see on my screens every day. I see the bond market right here and also another bond. It's called the mortgage-backed security bond. It trades on Wall Street. This bond is the biggest piece of your mortgage rate. Okay, so that's why I follow this. What you're seeing right through here is this is the price of a bond, the mortgage-backed security bond. So what we follow is what's going on in the price. So right now the price is up 28. Well, what normally has been happening is look at this red, and the arrow, the charts just keep going down, and down. When the price of the mortgage-backed security goes down, what happens? There's an inverse relationship. Rates go up. So today when the market is up 30 or 28, it's up 30 right now, we're probably going to see a reduction in rates by about 1/8%. We saw these numbers yesterday. So where were rates now? Well, this is where rates ended yesterday, okay? The day before we were at 7.2. All right. So we're down dramatically from where we were. We were teetering on the brink of hitting a 52-week high. You can see that at 7.375 right here. I'm expecting this to drop another eighth today because of what's going on in the bond markets right here. So we're going to be seeing rates about 6.8%, maybe 6.75 within the next 24 to 48 hours. Once this thing passes, or is it the debt ceiling, I think you're going to see more reprieve with mortgage rates. So my name is Dan Frio. I do this on a daily basis. Why? I want to make sure you're an educated consumer when it comes to buying your first house. So if you're looking to buy your first house, what do the numbers look like? How much do you qualify? Check us out. All I need you to do, it's over here, give us a call, 844-775-5626, or you can actually apply. If you're ready and you're like, okay, I'm ready to do this now, just hit the apply now button. Or if you're hesitant, you're like, I'm really scared to call, or you guys aren't available when I'm working, or I'm working during the day, so I can't get a hold of you guys. I have a consulting link down below. Just click that. There's a one-on-one consultant that you'll have on, you pick the day and time. We'll make sure we are there. It might be me or one of our other mortgage consultants to answer any questions that you have. So God bless, guys. Thank you so much for watching. I do truly, truly appreciate it. All I ask you to do is, if you like the videos, please give us a thumbs up, subscribe down below, because it helps the algorithms and helps us be found more and more on YouTube. So thank you so much. Don't forget, we will be live tonight. I got special guest. He is a VA specialist. So if you have any VA questions, please join us this evening, because I can assure you those questions will be answered. Take care, guys. I'll see you later. Bye-bye.